So I'm going to hand it right over to Stacy, but I want to make note that there's a couple of key things that we definitely need to talk about. Tuition and the last session. We're going to check in about those things intentionally. So just have those thoughts ready. But I'm also going to be facilitating for now, and then I'm going to step out for a while, and I'll be handing it off to Shane and Stacy, and I'll be back towards the end, just FYI. Okay, so without further ado, let's give it up for Stacy.
Yes. Alrighty then. So, did everybody get your handouts when you came in? Yes. Did you end up doing the, you did, I can see it, remember rights?
Oh, that one is actually, there's an extra stack of them out there. We gave these out the first day of class. If you don't have them, there's an extra stack on the table. If someone could pass them around, please. Shane or Julius, could you grab the stack of member rights and responsibilities that's on the table and pass them around, please?
And do we have anybody on the call or on the computer? Okay.
Not right now.
Alright. So, alright. So we're going to kind of blaze through this because, first of all, you have it on paper. Second of all, we're about an hour behind at this point. We haven't had dinner yet. So, okay, let's look at, okay, so you have the thing in front of you that's called Member Rights and Responsibilities. I have the same thing that's on the web. This was on cultivate.coop. This was level a second ago. I could use one. Yeah, let's forget about that. Let's just look at paper. So your rights and responsibilities as a co-op member are pretty much the main thing that makes your life as a co-op member different than an employee at any other company, right? This is kind of the whole thing that's different, is your power in the organization, your rights and responsibilities in the organization. So, Judy, I see a knowing look on your face. I always pick on you first. But I see a knowing look on your face, like, this is... So the rights and responsibilities of membership compared to just being an employee of somebody else's business, you know, what is something that comes to mind for you? Like, what's different about owning a business than it is just being an employee?
Well, I'm focused on responsibilities right now and how frustrating it is to assume those responsibilities when we're not really quite, we have to develop the capacity to do that. So, what makes it different is that somebody else isn't doing it for us. We have to do it ourselves.
Yeah, that pretty much sums it up. Azara, is this something that you've run into as well?
Yeah, I mean, it's like finding the right balance between like accountability to each other while also sharing power, you know.
Have you ever
what our rights are and what our responsibilities are, how do we hold ourselves to responsibilities.
Have you ever gotten into a situation where you end up feeling like you're treating yourself the way a boss might have treated you in the past? You know? Like maybe mistreated you even? There's a thing called self-exploitation, which we talked a lot about, that happens to a lot of entrepreneurs. And honestly, it's like people sacrifice a lot in order to own their own businesses, and you get to know really what that means. You know, people end up working without pay, working long hours, doing all these things that you'd rather not be doing. And it feels okay because you're an entrepreneur and you're doing it for yourself. But as a member of a co-op, you are also an employee, typically. And so you do have a right. You do have rights as workers, and you do need to try and respect your own rights as workers and not exploit yourself. You know? So I'm not going to go through this line by line, but does anything, you guys went over this, I think, the first day? So you guys have been through this document already. Okay. So I'm not going to spend a whole lot of time on it, but I am going to move on to one of your rights as a member of a cooperative is to share in the profits that you guys have created with your labor. And one of the ways to do this is through internal capital accounts. So we're going to move on to internal capital accounts. So a lot of you have been through this before, but it probably bears repeating. It was complicated for me to learn. It took me years before I really understood what we were talking about here. So I'm just assuming it's going to be all right to go through it again with you guys. Does that make sense?
Yeah.
Okay. So of the co-ops that are up and running, diggers, how are you guys organized right now? Do you have a legal organization? Have you formed an LLC or anything like that? Or you're part of Worcester Roots, right? So you're like a fiscally sponsored project internally in Worcester Roots. Okay. Is there anybody who is, well, Soul Chariots is an independent organization. And how did you guys organize? I can't remember.
We're an LLC.
You're an LLC.
Mm-hmm.
Okay.
Neuron Robotics is a worker cooperative corporation, and they're not here yet.
Okay. So this is typically how internal capital accounts work in an independent cooperative. So this isn't going to be technically relevant to the co-ops that are still legally a part of Worcester Roots, but I think you guys should be aware of this structure anyway. And for Soul Chariots, for an LLC, you can design it to work this way, but there's some kind of tricky stuff about that, which I'll get into. So is it only the robotics group that's set up as a corporation of people here? Or is the greenhouse thinking about being a corporation, or is that going to be part of Worcester Roots also?
For a little while, part of Worcester Roots. Yeah.
Okay. Okay. Well, let's go ahead through. So,
I know Future Focus wants to incorporate soon and is interested in looking at this.
Oh, okay, good.
And,
Okay.
and Little Village is
Okay.
incorporating.
Okay, great. Okay, so it is relevant for some people in the room. Just
Oh
making
yeah,
sure.
and the
We also intend to incorporate.
Okay, good. Everybody intends to incorporate. Okay. Okay, so one of your responsibilities as a member of a co-op is to capitalize the co-op. It's your job to put in the startup capital and the ongoing capital that makes your business run, right? Which can be a tricky thing to do when you don't have any. So the internal capital account system is a way that's been created to, in the spirit of stone soup, for people who've got nothing to make something out of nothing, essentially. And this is how we do it. Not something out of nothing, but something out of less than there was. Whoops, that's not what I meant to do. Okay. So, generally what happens in a co-op is that all of the members, so each of those green blocks represents the initial investment of a member in the cooperative, okay? So in order to, you'll find on that sheet in the rights of workers, one of the responsibilities of members of a worker co-op is to pay a membership fee. Generally, you buy a share in the corporation, or you purchase a membership in an LLC. It's an analogous kind of thing. But either way, you're buying a membership share the way that you would buy, dues. You would pay dues in any kind of organization that you belong to. When you buy a membership share in a cooperative, it's only a one-time thing. It's not like every year. You buy it when you join the cooperative. And you can set the amount of this at any price you want. People set it at $1. People set it at $25,000. That's the spread that I know of. I don't know of anybody who charges more than $25,000. There might be out there. Typically, people, people have all sorts of reasons for putting a price tag on this. Sometimes they say, well, we want people to really feel invested in the co-op. We want it to kind of hurt, We want people to really want to join, and we want it to feel like it's a major commitment, So I know co-op people who who suggests that you charge the price of a good used car in your neighborhood, you know? So what would you pay for a good used car in your neighborhood? I don't know. It depends. It depends on what you think is good. It depends on your neighborhood. But if you also have, you also have this goal that you want this to be accessible to people too, right? So there's this kind of trade-off. So the people who charge $1, for example, are leaning more towards we want this to be accessible to people. And the people who charge $25,000 say we want this to hurt and we want you to really, really want to be a member of this co-op. So whatever kind of co-op you are, you can decide on what that price is. And everybody starts equally. That member's share price is the same for everybody coming in. So then what happens? You put in your equity, you've got your capital, you set your capital in motion, however you do it, and you start throwing off profits, right? That's the idea. And then, so you're operating your business, you're making profits, let's say. Here's what happens, as an example. So let's say this business had an income of $500,000 in this year that we're talking about that it operated. It had costs and expenses of $450,000, so it had a net income of $50,000. Does everybody see that? They took in $500,000, they spent $450,000 on all the stuff that they needed to do business, and what they were left with at the end of the year was $50,000, right? That's their net income. That's also called your net profit, and some people also call that your bottom line, you know? So people say in the black. You know, if this number is above 0, people say you're in the black and you've made money. If it's in the red, you've lost money. That's an accounting convention because an accountant will, write those numbers in black when they're positive and in red when they're negative. So, anyway. So we're in the black. We made $50,000. The first thing that we have to do is divide that net income into 2 parts. We divided into the profit that was generated by non-members and the surplus that was generated by members. Is this starting to feel familiar to anybody who was in the Co-op Academy last year? Not very.
Yeah, I remember the difference between surplus and profit.
Okay. So the difference between surplus and profit. So, surplus is treated in a special way in cooperatives because it was generated by members. The idea is that any surplus that was generated by members is not subject to the same kind of laws and stuff that the profit that's generated by non-members would be. And I think the next slide will explain that a little better. So your non-members would be people who are not yet members of your co-op. If you have people who are working for the co-op who are still in their probationary period, they might be in their first 6 months or something where they haven't yet become a member of the co-op. Those people would be non-member employees. And any profit generated by their labor would be siphoned off at this stage. And all this means is that you would take your profit, you would take your net income, and you would divide it by the number of hours that everybody worked in the business. So if 90% of the hours were worked by members, well, let's see, in this example, 80% of the hours were worked by members of the co-op and 20% were worked by non-members. That's why the $50,000 was split that way into 10,000 and 40,000. People see that? Because 40,000 is 80% of 50,000. It's already too mathy, huh?
So, non-members could be anyone. Subcontractors?
No, only employees.
Okay.
Oh.
Only employees, yeah.
So it could be somebody that's towards their membership, but
Well, let's see. Maybe I should backpedal on that a little bit. So if you're set up as an employee corporation, so Massachusetts has an employee corporation where you're only eligible to be a member of the cooperative if you're an employee. So people know the difference between being an employee and being a contractor. So if you're an employee, then you're a member of the employee cooperative and you have those special rights and protections as employees. So you define in your bylaws who are the eligible members of the cooperative. So if employees are the members of the cooperative, then you're talking about profits that were generated by the employee members as opposed to the non-member employees, not contractors. But in other kinds of cooperatives, you might not be employees. So you guys are
contractors.
You're all contractors?
We have owners and we have contractors, private contractors.
Okay. Yeah, how does this work for you? So you have owners and contractors. You have owners who are members of the LLC and contractors who are not members of the LLC. I would check with Gowrie on this, but probably this applies to you.
Yeah.
I think it probably does. Yeah.
So in the case of the diggers, you know,
Yeah.
like, and I think to elaborate on the question that Judy asked, the way that, like, sometimes if you don't have members available, say we're working a job and we need you know, extra hands on the job,
Yeah.
we will employ people that we know, people with relevant skill sets. If our co-op doesn't have the skill set, they will be like subcontractors, right? But
Yeah.
but in this case, it seems like the money that we make from them would be profit and not surplus.
You know, they would be an expense.
Yeah, I mean, I'm not completely sure about this, and probably if you asked a lawyer, they might not be completely sure either.
Right.
The government has not always figured out what it thinks about cooperatives, and a lot of this law is on a state-by-state basis, so
Right.
you might get a different answer depending on who you ask.
Right.
But it's possible that, those subcontractors are a direct cost of your business. And maybe if everybody else is treated as an employee, here's the thing, if the members of your co-op are all classified as employees, but you also have 1099 people, then probably I think that they don't count in this equation.
Okay.
But if the members are 1099, if they're not employees, if your members are not employees and you guys are getting a 1099, but you also have other people who are getting a 1099 who are not members, then I think this would probably apply.
Oh.
That's how I think it probably works, but I'm not a lawyer, so you can't believe anything I say. But that's how I think it probably works. You'd have to verify it.
And I just want to say, like, one of the things that you want to be very careful is, like, not having contractors that do the same things that employees do.
Yes.
Because then you're going to be in deep shit with the law.
Right.
So we have it very clearly defined, yeah.
Because you have to hire them as employees.
Massachusetts has really strict laws
Yes.
about independent contractors.
It's misrepresented.
Sorry?
It has misclassification.
Misclassificate, yeah. If you look up information about misclassifying employees as contractors, you'll find the criteria. There are very strict criteria, and it's stuff, I don't remember them all, but it's stuff like if someone who's an employee of your business is like directing the work of this person and supplying the tools that they need to do it, then they really should be considered an employee. If somebody's coming in as a contractor, meaning they own their own tools, they've given you a bid on the price for the work that they're doing for you, they're working for other customers as well, they're definitely self-employed, then you can call them an independent contractor. But it's complicated and you should check the law on it, especially in Massachusetts. But yeah, those are your Google keywords. Massachusetts misclassification of employees.
I'll put it in the notes.
Yeah, that'll get you to where you need to be. Okay, so we haven't even gotten to the internal capital accounts yet. Does anybody remember what the first slide looked like with the member equity? Okay. So keep that in mind. So here's what happens. That $40,000 in surplus carried over. So now we're just dealing with that $40,000 in surplus. We took the $10,000 and we put it aside. We put it aside actually somewhere in the vicinity of that blue bubble. Okay, so imagine that the 10,000 is in there, but you don't actually see it on the slide. I need to redo these slides. So we're taking our $40,000 in surplus, and we have to make two decisions about this money, right? This is the money that the members have generated with our labor, right? So we have to do two things. The first decision we have to make is how much of that money are we gonna save in a collective account for all of us to use for the business, and how much of it are we going to assign to individual members for their individual accounts, right? So this is a big question, right? You know, you could spend hours arguing over this, and you probably will. What would be some of the reasons to keep it in a collective account? What are some of the things you might need that money for?
Grow the business.
Yeah. Grow the business. You know, maybe buy new equipment. You know, we're gonna maybe pay for a garage to keep our vehicles in, our tools in, things like that.
That's exactly what you would use it for. You'd use it for some kind of investment, right? You might use it just to have extra cash in the business. If you're feeling like you're pinched for cash, you might just want to have more cash in the bank. Or you might want to invest it in machinery, equipment, or any kind of thing. Training, you could invest it in training your employees better, any kind of thing. If you feel like you have plenty of money for that sort of thing, then what you might do is say, okay, we're gonna draw down some of this profit that we've generated, and this is gonna belong to us now, individually. Once you've allocated that, once you've decided that that's we call that patronage, when it's assigned to your labor. So it's a return that you got on your labor for that year. Once it's assigned to a person in the co-op, it belongs to you and it can't be taken away from you again. That doesn't mean you'll necessarily get it in cash. It just means that the co-op can't just decide that it's not yours anymore. The co-op could go bankrupt and you might not ever get the money. But the co-op can't decide that that's just not your money anymore. So once you've allocated that to patronage, once you've said that belongs to the individual members, you can't go back on that.
But it's not necessarily paid.
Exactly. That's what we're getting to. So this is the whole thing where people with nothing are making stone soup from their co-op, right? You're making something out of nothing, and this is exactly how you do it. So you've just worked the whole year, right? You got paid, $12 an hour or something. At the end of the year, the co-op made this $40,000, and that $40,000 is money that really could have been paid to you guys. You could have made maybe $14 an hour instead of $12, but you made $12. The $40,000 represents that extra $2 for every hour that you worked, right? That's how you generated that surplus. So now you're trying to figure out what to do with it. Part of it you've decided is going to be put aside for investment, and part of it is coming back to you as kind of a refund. Because you're like, you know what, I'm going to take that $14 an hour I should have made this year instead of the $12 that I got paid, right? Is everybody with me? Mm-hmm. So calling that, not so much?
No, I'm good.
Okay. So calling that a patronage dividend, so now, that's been assigned to you, that money, right? That said, Judy, you're getting $2 for every hour that you worked in the business this year, because we could have afforded to pay you more money, but we didn't because we were being conservative, but here's the thing, we kind of still need that money, and we need Judy to be an investor in this business because she's an owner of the business, and it's her responsibility to capitalize the business the same way, a rich person might do if they were just born with a trust fund. Someone's born with a bunch of money, they put it into their business, and that's how rich people start businesses. Poor people don't have that, right? The only thing that we have is the fruits of our labor. And this is the fruits of our labor, and this is how we reinvest it back in the cooperative, okay? So when that money is assigned to you as your patronage dividend, that belongs to you. The next decision that you have to make is how much of it are you going to take in cash that year, and how much of it are you going to leave as an investment in the co-op, okay? So you've gotten this extra chunk of money at the end of the year. You've gotten your $2 for every hour that you worked. You have to take some of it in cash because you're going to get taxed on that money. Once it's assigned to you, it counts as income to you on your tax returns, and the government wants tax on it. So that's why you generally get paid. You get paid some of this money in cash, and your co-op decides how much to pay you in cash. Usually it's something like 1/4 to 1/3 of the money gets paid in cash, because that's how much you're going to get taxed on it. The rest of it goes back into the business. You reinvest that back in the business, and it sits there for maybe a few years. That's how it's typically done. The way it's typically done is that money will sit in the business for maybe 5 years, and then after 5 years, you also take that out in cash, right? So in the year that we're talking about, the money belongs to you. It's yours. You get taxed on it. It's got your name on it. Nobody can take it away from you. But you've kind of voluntarily let the co-op keep some of it for a bunch of years, and that's how you invest in a co-op. Got it?
So it's like an ongoing membership.
Kind of. So here's the effect, right? So each member, because it's per hour that you worked, each member might get a different amount at the end of the year, right? So at the end of the year, here's what it looks like. You had your member equity where everybody put in the same amount, right? And that's still the same. It doesn't change. Now you also have this member retained patronage on top of that, and it's different, depending on how much time you worked in the co-op. When you leave the co-op, you're supposed to get this back. You should get this back if the co-op is financially healthy, you should get it back. Some co-ops make it so that you get it back over a period of years or something. But this is your money. You've invested it in the co-op. It belongs to you. And the idea is you get it back when you leave the co-op. So, questions about this? Because
So there's no
we're gonna move
penalty
along.
for separating from the co-op?
Well, it depends. It depends on how you set it up.
And if people leave mid-year, is it prorated for the year? How does?
Well, what happens is at the end of the year, you add up how many hours everybody worked in the co-op. So if somebody left halfway through the year, they have to wait till the end of the year for this calculation to happen anyway. So they wouldn't even get any money back until after the end of the year.
And can it only be done by hours? Is it done proportionate by hours, or can people?
That's a good question.
Can you say, well, we're able to do these wages now, but we want to split it up differently based on people's needs or things like that?
You can do most things if you talk to a lawyer and make sure that they clear what you're going to do.
Is that the bylaws?
You can also, this stuff can be in your bylaws, but and your bylaws should be reviewed by a lawyer. So there's a few other things you can do. A co-op can also give bonuses just like any other business. You guys can decide to give bonuses to people on whatever performance criteria you have. Giving people bonuses based on need, I would just check the employment laws about that. I don't know that there's any rule against that, but I would just check. So if you wanted to, you can bypass this whole system if you want and just straight up give people bonuses.
I have a question.
Yeah.
I was just wondering, so what is it called when you lump those two things together? So the member equity plus the member retained patronage, is that a word for that
That's
just
your
your
internal
that is
capital
your
account.
Okay,
That's the
what
whole
it's-
thing,
what
that's your
is it?
internal capital account.
Internal capital
Yeah.
account. I spoke
Hi.
those things. And then another question I
Yeah.
had, can you pay out dividends at multiple points throughout the year? Or is that generally just at once a year at the end of the year?
Good question. Yes. Okay, so one thing is that, one thing that you should know is that an LLC typically does not have that retained portion. Typically an LLC is a pass-through tax entity where, like, basically everything I just said doesn't really apply. I know that in Massachusetts, LLCs can elect to be taxed as corporations and then this becomes relevant, but I'm not sure if it's the same in Rhode Island.
Yeah. All we're trying to do is we're trying to set up some sort of semblance of a capital account for our members, even though we don't have to do it that way because we're not technically a cooperative. We do want to still have some established member shares and capital accounts.
Yeah, I think that's the whole thing about an LLC is that the money can exist in an account. You can decide to not draw it down in cash. But basically in an LLC, all of the money theoretically has somebody's name on it. You know, all of the money belongs to one of you in theory. So basically it's like all of the money is in these internal capital accounts. None of it is in a collective account. Unless you can finagle a way to do that, which is another, it's
Or
another
unless we just kind of
lawyer
make it
thing.
up in our own books, whatever, that this is our dog for like labeling this amount of money as being our collective account, right, that we can dip into.
When you do your taxes, it's gonna become, I'm not really sure. I think when you do your taxes, it's gonna, your accountant is gonna say, you're an LLC, you can't do that. It's gotta have somebody's name on it. But unless you can do this thing where you elect to be taxed as a corporation, which you might be able to do in Rhode Island, I'm not sure.
We know we can, Gary told us, but we opted not to do that for now, so that's a whole other.
Alright, great, great. Okay, so, yeah, so I mean, you've got, like, Gary's like the best there is to figure this stuff out, so,
Right.
yeah, half of
Like
what I know
being
is
taxed as a corporation, we'll get taxed twice, pass through, we get taxed once, is the way to
yeah, probably,
that was
probably,
orange.
yes,
Green version.
probably yes. Okay, so am I seeing that there's food arriving, is that what
Food
the
and
bustle
more
is?
people.
Food and more people, so should we go ahead and take the break for dinner?
Probably good. I don't know where facilitator went, but yeah, I think so.
Yeah, okay, I think we're gonna need to take a break for dinner. So let's go ahead and do that.